Hey everyone, this is Marshall aka the Theta Trader, and in this video we'll be talking about cash secured puts. So if you haven't watched my previous videos over what are options and the options Greeks, I suggest you pause this video, go watch those two videos because you're really going to need a firm understanding of the concepts that are in those videos to really grasp what's going on in this video and how to really use this to the full benefit that you possibly can out of this. Basically, in this video, we're going to talk about why I think cash secured puts are the best strategy when trading options and how they can be used to generate passive income with very little management on the seller's side. So we're going to talk about what is a cash secured put, what that agreement looks like between the buyer and the seller, what assignment actually is and how to avoid it. Lastly, I'll show you my strategy with cash secured puts, and I'll show you how much I've made since the beginning of the year selling puts, just to show you guys some transparency that this strategy actually does work. And if you like this video, don't forget to like and subscribe. And with that, let's get right into it. Okay, first, before we get started, I think we should do a small recap on the buy side of puts. Like I said, if you want a more in-depth explanation of what really happens when you buy a put, go check out my What Are Options videos. It's going to explain it way better in that video. But just to give you the three main points, buying a put gives you the right to sell 100 shares of the underlying at the strike price at expiration. And you have to remember that the premium goes up as the stock price goes down. And a put is considered in the money if the strike price is higher than the current share price and out of the money if the strike price is lower than the current share price. Now, if some of those terms confuse you or anything like that, like I said, go check out the previous two videos. They're going to explain those a lot better and a lot more detail than what I just did right there. But just to give you a slight recap before we get into the sell side of puts, just want to do a quick recap on the buy side. So now let's get into what is a cash secured put. So a cash secured put happens when you sell a put that you do not own, and this is called sell to open. I think we're all pretty familiar with what buy to open means. It's when you don't own something and then you buy one of it. Right? That's going to be a buy to open. And then you sell to close what you bought to open. So say you want to buy 100 shares of Apple, you buy to open 100 shares of Apple. The Apple goes up by $1, you want to sell to close your position for those 100 shares of Apple. Well, since we don't open, we're going to actually sell to open. And then when we close this position out, it's going to be called buy to close. And because of this, we're going to get basically negative equity in the stock market. So we're able to do this selling of something that we do not own because we have to put up some type of collateral, and this is going to be the secured cash part of it. And the collateral has to be put up in case we have to buy the 100 shares that the buyer of our contract will sell if the contract expires in the money. So if we go back to this recap, buying a put gives you the right to sell 100 shares of the underlying. Well, if we're selling a put, we have to put up the money just in case that put expires in the money and they need to sell their 100 shares. Well, we have to put up the money to buy those 100 shares before we're allowed to sell this contract. So the buyer of the contract pays us the premium, which we get to do whatever we want with. So if the premium of the contract is $100, they're going to buy that contract for $100. They're going to buy to open a contract from us for $100, and we're going to sell that for $100. So we're immediately going to keep that $100 of premium. So I have a little visual representation of what that all means because it was probably really confusing when I said it. So I set up a fake scenario here. So we have a share price of $11. The strike on this put is $10. The premium is 50 cents or $50, so we have to multiply by 100, and it expires in 4 weeks. So us, the seller, we have $1,000 to put up as collateral because that's the strike price times 100, and we think that the share price will stay above $10 at the time of expiration. So in 4 weeks, we think it's not going to go below $10. It's going to stay at 11 or even go higher. The buyer of this contract owns 100 shares of the underlying and thinks that the share price will go down past the strike price by expiration and wants to sell them for $10. So what's going to happen is we're going to sell one put contract and receive the $50 in collateral instantly. Now to do this, $1,000 will be subtracted from our buying power when that happens. If the put sold expires in the money, the seller, which is us, will have to buy the 100 shares of stock from the buyer at the strike price. So in 4 weeks at the expiration of this put, if the share price is at $9, we're going to have to buy the buyer's 100 shares at $10 a share, even though the share price is at $9. So we're instantly going to lose that $100 between the strike price and the current trading price. But if the put expires out of the money, the put will expire worthless, and the buyer will lose all the premium paid for that put, and we will receive all of the premium that we sold that put for. Now, going over to the buyer side, the buyer is going to pay $50 for that put contract, which again is going to go to the seller. If the put expires in the money for the buyer, they will sell their shares at the strike price to the seller. And if the put expires out of the money, the put will expire worthless and no shares will be exchanged between the buyer and the seller. The buyer will just lose the $50 in premium that they paid for the contract. So you may need to go over this slide a couple times just to really get that fundamentally in your head, because this is going to be like the basis of what all these other slides are culminating towards, basically. So really watch this 2 or 3 times to basically really understand what's going on here, because this is how the sell side of puts and calls, which is going to be a later video down the road, this is how it all works right here. It's basically just the inverse of buying, and sometimes that confuses people. So like I said, just watch this a few times and I promise it'll all make sense. Next, let's look at some rules of thumb for selling cash secured puts. So I would say the number one rule is don't sell cash secured puts on stocks that you're not comfortable on owning the shares. Because like in our example above, if this drops down to $9 and you have to buy the buyer of your contract shares for $10 a share, even though it's trading at $9, you're going to really want to hope that it's at least going to get back up to your strike price again. So don't sell cash secured puts on stocks you aren't comfortable on owning, stocks you aren't bullish on, because once you own those 100 shares, they're yours, and you could keep on incurring a loss on those after you buy them for the higher strike price. The next rule of thumb is sell as close to a 0.3 delta as possible. This gives you a probability of expiring in the money is pretty low. At 0.3, it only a 30% chance of expiring in the money, but it's close enough to the current share price to make a pretty good premium and make that risk of us selling this put worth it, basically, because the Greeks are risk assessments, remember? So it makes the risk worth it, in my opinion, to sell at the 0.3. Next rule of thumb is to sell 30 to 45 days to expiration puts, and this is going to take advantage of the more extrinsic value of that put, and theta will decay that off over time at a more rapid rate. The next rule of thumb is buy to close as early as possible, and that's because let's say let's go back to this example. We got $50 in premium for this, and it's 4 weeks till expiration. Now remember, we have negative exposure in the stock market right now. The stock market basically owes us $50 that it already gave us. So let's say in this example that the share price just goes crazy, and it goes from $11 to 15 or 16 bucks in this first week. And let's say this premium now goes from $50 to, let's say, 20 bucks in the first week. You've realized 60% of your total gains that you could have made on this trade in the first week. So it'd be a good idea to buy to close that position, take your negative exposure into the stock market back to a neutral exposure to the stock market, and get out of the trade and take your 30 bucks and run with it. So next, let's look at assignment and how to avoid it. So assignment is when your short put option expires in the money. So short put just means that we sold it. It expires in the money, and the collateral you use to sell that put buys the 100 shares of the stock at the strike. So typically when I sell cash secure puts, I don't want to get assigned ever. I never want to buy that 100 shares of stock. I just want to collect that premium and do nothing for it, basically. So to avoid this assignment, we'll want to do what we call a roll. And so we'll want to roll out our short position to a farther out expiration at a lower strike price. So this is what it's called, rolling out and down. Out referring to the farther out expiration, and down referring to the lower strike price. And the reason that we want to do this is because, say, I'm going to keep on going back to this. Say the strike price, we did sell this at $10, and then in 4 weeks, it's sitting at $9. I don't want to buy this stock, whatever it may be, at $10 when it's trading at $9. That's just not a loss I'm willing to incur. It's not something that I anticipated. I thought it was going to stay above $10 the entire time. So what I'm going to do is I'm going to buy to close this put option that I sold, and then simultaneously I'm going to sell to open another put 4 weeks out. Let's just say 4 weeks out again. Only I'm going to sell to open this at a $9 strike instead of the $10 strike. Now, if everything goes well, you'll actually be able to roll this with a credit to the account, meaning that you will actually get more money from selling to open this new, further out, lower strike. And that's because the extrinsic value will have been shaved off so much from your original put that you sold that the new put that you're selling is going to have so much extrinsic value left inside of it that it's going to be worth more than the original one that you sold. So let's say at expiration, the premium on this put that we originally sold was, let's say at expiration it's worth $20, right? Or no, let's say it's worth 70 because it's worth more money because now it's in the money. Let's say instead of 0.5 it's worth 0.7. Well, let's hope that when we roll down and out, that the new put that we sell is worth around 1. So we'll actually get $30 more in premium, but we'll have to wait another 4 weeks for our collateral to be freed up. So that's kind of the give and take. We get a little bit more premium for it, but our collateral is locked up for a longer period of time. All right, let's look at an example of what rolling a position down and out would look like. So let's assume someone in the past sold this $35 put, and now it's in the money and they don't want to get assigned the shares. Well, what they can do is they can buy this put back. So they're going to buy their put for $2.39, and then they're simultaneously, so let's roll it out 30 days basically. So let's roll this out and let's go down. So our total debit right now is $2.39 because we're going to have to buy this put back. We're going to buy to close. So $2.39 is what's going to cost us. So now let's look for something, since we're so far out, we're 30 days out now. So now let's look at something where we can roll this for a credit. So this is going to be the down portion. So we're going to roll it to a lower strike price and out to a further out expiration. So let's look for another 30 delta. Oh, here we go. This $30 one, 30 delta, 363. So then we're gonna we're going to sell this one. So as you can see, we're actually going to roll this out for a credit. So we're going to buy this one for $239, but then we're simultaneously going to sell another one for $363, which means we're going to get another $124 in premium for rolling this put out of the money so that we never get assigned to this position. We never get assigned those shares. We never have to buy the shares. We just roll down and out to a further out expiration, a lower strike price, so that way hopefully by March 5th, then we won't get assigned the 100 shares and we can just keep all of our premium. Now, obviously, the downside of this is that our buying power just keeps on being decreased for a longer period of time. So originally we had $3,500 in buying power taken up from this put up here. So we'll decrease our buying power that's locked up, because now we can release $500 of this buying power, because what did take us $3,500 to put down now only costs us $3,000. But we still have $3,000 that are locked up, and we're putting up $3,000 for only $124 more. So I would say you want to avoid having to roll. Choose a position that you don't anticipate you'll have to roll, but this is a good way to get out of the position without actually buying the shares. You can just roll for a credit. Okay, so now let's go over my strategy and what I look for when selling cash secured puts. So the first thing that I do is find a stock that I'm bullish on, because again, just in case of assignment, which I really try not to do, but just in case of assignment, I want to find a stock that I am comfortable owning 100 shares on. And then also I want to look for a stock that has high implied volatility. Now, why the implied volatility matters so much is because of that Vega value, that Vega Greek that we talked about in the previous video, and how much of an impact that can have on the premium when selling. So I have two examples pulled up here. So first one I have is Microsoft. Again, this I got it close to as 0.3 delta as possible, right? We're looking at, we should look at selling, but it doesn't matter. It's not gonna change the price. So we're gonna sell a put. Here we have 0.3 delta. Now again, the collateral that we're gonna have to put up is the strike price times 100. So it would cost us $23,000 to sell a $230 put and receive close to $400 in premium. So again, we're gonna sell to open. $23,000 will be subtracted from our buying power, and we will instantly receive around $400 for selling this put. Now, if we look at the implied volatility on this option, it's sitting at 28%. Now, the reason that this is so low is because Microsoft is a huge company. It has like a $2 trillion market cap or something like that. So implied volatility on giant companies are just typically not high at all, even around earnings time. It's just not very high. So that means this Vega is really low, and it just doesn't contribute much to this premium right here. Now, if we look at Workhorse, which is a stock that I'm very bullish on, and we go to, I thought I already had this pulled up. I think it's the 30. So here's the 30 delta right here. So in this scenario, we're going to take this $30 strike. We're going to multiply it by 100. So that's 3,000. So that's the amount of collateral that we're going to have to put up. But if we look at the premium that we're going to receive, it's literally almost as much as the same as the stock that we would put up $23,000 of collateral up. So we put up way less collateral, and we get almost the same amount of premium for the exact same expiration date. This is about 4 weeks out. So, and that is because of this implied volatility. This is sitting at 148% implied volatility. So this implied volatility is contributing so much more to this options premium when we sell it, so we can put up way less collateral and receive way more premium for this. So what I'm looking for when I go into this is I want to see high IV to me is basically anywhere between like 80 and 200%. I don't like to go any lower than that, and I also don't like to go any higher than that. And that's because if it has higher than 200% implied volatility, that means something really crazy is going to happen with the stock price in the time that you own, or I guess sell that put. So I don't like to go too much higher than that because it's just too unpredictable. I don't like to, again, these are risk factors. I don't like to take on that much risk, basically, is what I'm saying. Then I wait for the stock to have a red day. So if we look at Workhorse right here, Workhorse actually lost 11% today, meaning that this this put actually increased in price by 23%. So we see previously it closed at 294, now it's sitting at 363. So I wait for the stock that I choose to have a red day because that's when these puts are going to be worth the most. And since the stock price went down 11%, I can go down even further. Like, say if I would have sold a put before it went down 11%, let's say it was trading at 37, right? Well, maybe at 37, 34 was the 0.3 delta. Well, now 34 is sitting at a 40 delta, you know? So you can go down further in strike if you wait for that red day and hit that 0.3 delta and still make a good amount of money on your premium. So the next thing I do is sell the cash secured put. Again, that's going to be the 0.3 delta and 30 to 45 days till expiration. So this 3A part right here, this is just me personally. I try to make it so that the premium that I get from the put sold will net be about 2% a week versus the amount of collateral I put up. So if I look at this workhorse option right here and I'm deciding if this is going to be good for me or not, I'm going to get, if we just look at this, we're going to get $363 in premium. We're going to divide that by the $3,000 in collateral that we're going to have to put up. We're going to multiply this by 100. So we're going to get 12% on our money. And it's going to take us 4 weeks to realize 100% of that 12%. So this is going to net us 3% a week. So I would say this is an extremely good trade to get into. And I would, if I had $3,000 free right now, I would probably trade this tomorrow. Honestly, this looks like a really good trade. Now again, look at the stock chart, do your due diligence, do some technical analysis, make sure 30 actually is a good price. I mean, it did lose 11% today, so make sure that it's not going to lose, 20% tomorrow. Do some due diligence and make sure. But in my opinion, workhorse I'm bullish on. Even if it dropped to 28, 29, I'm comfortable owning those 100 shares. I'm really, really bullish on a workhorse. So there's that. Now, the next thing is we're going to wait until the week of expiration, and we're either going to buy to close our position or we're going to roll that position out for a credit. So looking at this workhorse thing again, if it stays above $30 this entire time and it never drops below $30, you're 100% in the clear. You can wait all the way up until that last day. This put will probably be worth 10 cents, 15 cents at that time. And you can buy to close that at $3.45. So you'll realize $345 of that $363, and you'll have netted a ton of profit. Next, I just want to show you guys that this is a strategy that I implement, and just going to be fully transparent with how much money I've made on this strategy since January 11th. So the reason I picked January 11th was that's when I switched everything out for my Robinhood account and put it into Thinkorswim or TD Ameritrade, however you want to call it. So this spreadsheet is linked in the bottom. This is the spreadsheet that I'm going to be doing weekly account reviews on. You can see every single trade that I'm in. When I close it, I update the spreadsheet immediately. So we actually, if we go down here to this CSP tab, this is my cash secured puts, and we can see that since January 11th, if we look at this sum right here, I've actually made $1,325 in roughly 3 weeks of trading. Now I did close one of these on, yesterday. So yeah, that's about 3 weeks. So January 11th, 1, 2, 3 weeks out, made over $1,300. So I think this should be a strategy that everyone who's trading options should take advantage of, because it's just such easy money. And I really don't have to do anything. I sell to open the position, I put up the collateral, I wait, and I profit. I would like to talk about one more reason why cash secured puts are so awesome. This is not something that I typically use them for, but I do know people that do use them for this use case, basically. So a cash secured put is really a good way if you want to buy 100 shares of the stock price, but you don't want to buy it at its current price. So Workhorse is trading at $34 right now. Let's say you think that $34 is overbought for Workhorse and you don't think it's worth more than $30, basically. We can sell this put and we can guarantee that we buy those shares at $30 a share. This would be the same as putting in a limit order, basically, for the $30 share price. But in this case, we're getting $363 for basically putting in a limit order. Not only are we getting that $363, but we can apply this $363 to each one of the shares that we get, and now our break-even share price is actually going to be $26.37 because we can subtract this premium per share from each one, and then our actual entry price into the stock becomes so much lower. So that's just another way that people use cash secured puts. I don't typically use them this way. I don't typically use them to buy shares. I just want to collect the premium and be done with it. But there are people out there that will basically use the cash secured put as a way to put in a limit order, but then also gain premium because they want the 100 shares. They want to get assigned, basically. So just another use case. I thought I'd put that out there for anyone who might want to use this versus the rolling and not wanting to get assigned play that I usually do. All right, everyone. So that is cash secured puts. Everything there really is to know. Well, everything that I know, and I'm profitable doing it. So as far as I'm concerned, that's everything there is to know about cash secured puts. Really hope you guys liked the video, found it informational. I really hope you guys are motivated to get your feet wet with options. I think that this is a great place to start because the risk is very, very tiny. You can start doing this with very, very little money. I mean, Ford Motors, F is the ticker symbol. If you want to look those up, it's literally trading at $10 a share right now, or maybe a little bit more than that, but you can sell a $10 strike, so you only have to put up $1,000 in collateral. I'm not sure how much the premium is on that right now, but I know the implied volatility is at around that 80% number that I was telling you guys. That is like the lower end of what I like. So I hope that everybody watching this video tries to implement this strategy because the returns on it, I mean, you're not going to be a millionaire overnight, but it is the slow, consistent gains, and all that does is just keep on compounding. You can use that $50 next time to get into something more, and then maybe next time you can sell 2 cash secured puts instead of just 1, so you can take that $100 and do something else with it. And like I said, it just keeps on compounding. Even if you only shoot for 1% a week, I mean, that's 50% on your money every year, so that's way outpacing the market. I shoot for 2%, like I said, so realistically, if I never even reinvested all my gains, I should be making double my money at least every year. So again, this is like, in my opinion, the best option strategy right here because of just how little downside there is if you just stick to the rules of thumb and my strategy basically going forward. Like I said, I hope you all found it really informational. I hope you all really want to get your feet wet and start trying out this strategy. If you like the video, please give it a like. Please subscribe. Really helps out the channel. I don't think I have any more for you. I'll see you in the next one.